The lending institution. Part 2. Let's talk about employment verification. The bank, credit union, or financial institution, the lender, will verify your employment history for at least 24 months. Lenders prefer applicants to remain in the same profession or line of work during this period. A. Income tax. Lenders will confirm whether you are a W-2 employee, employed by a company, or a 1099 independent contractor, self-employed. If you have owned a business for less than 2 years, a CPA letter verifying your income and business operations will be required. B. Gross income. Gross income is the amount you earn before deductions. Common deductions may include federal, state, and local taxes, Social Security, Medicare, and other withholdings. C. Debt to income. DTI ratios. Your monthly recurring debt is compared to your gross monthly income to calculate DTI. Note that rent and utilities are typically excluded when applying for a mortgage loan. Current back ratio DTI limits for conventional loans generally range from 43% to 50% depending on the program. Three. Legal status in the United States of America. Applicants with the following documentation may apply for a mortgage loan. A. United States citizen, native-born or naturalized. B. Permanent resident, holds valid permanent resident status. C. Social Security number. A valid Social Security number, SSN, will be verified by a third-party agency. D. New legal resident. Applicants who have recently obtained legal residency and a new SSN for employment must transfer earnings from any previous SSN to the new one. It is the applicant's responsibility to notify the IRS, SSA, and their employer about this change promptly. E. Foreign nationals. Tourists, students, and professionals on valid visas who own properties or businesses in their native country may apply for a U.S. mortgage loan. A down payment of 20% to 30% is typically required, depending on credit history in the home country and the loan type. F. Immigration status verification. Foreign applicants should consult an immigration attorney to confirm legal status in the U.S. before proceeding with a mortgage application. Four. Importance of pre-approval. A. Pre-approval. Before property search. Obtain pre-approval from your lender before searching for real estate properties. Without pre-approval, you risk wasting time on properties outside your budget. B. Loan status report, LSR, or conditional loan approval, CLA. After completing the 1003 mortgage application, your lender will issue a pre-approval letter, referred to as an LSR or CLA, depending on state-specific terminology. C. Real estate purchase contract, REPC. Once your offer on a property is accepted, the lender will begin verifying all submitted documentation. D. Loan expenses and credit report. Discuss application expenses with your lender, including the cost of a tri-merge credit report, which compiles data from all three major credit reporting agencies. Five, understanding closing costs. A. What are closing costs? Closing costs are fees associated with purchasing real estate. These typically include lender fees, title and escrow fees, appraisal fees, and prepaid costs such as property taxes and homeowners insurance. Seller contributions toward closing costs may be negotiated in the REPC if allowed by the loan program. B. Common closing costs. 1. Appraisal fee, required by lenders to confirm the property's value. 2. Processing fees, fees for organizing and verifying loan documents. 3. HOA transfer fees, if applicable, prepaid fees for homeowners association dues. 4. Discount points, optional fees to buy down the interest rate. 5. Origination fees, loan officer or lender's commission. 6. Prepaid reserves, includes property taxes, homeowners insurance, and if applicable, private mortgage insurance. PMI, for conventional or mortgage insurance premium. MIP for FHA. See additional considerations. 1. Regardless of payment method, cash or mortgage, closing cost will apply. 2. Closing costs vary by lender and loan type. Always review lender estimates and title and escrow company for accuracy and transparency. 6. Financial recommendations. A. Budget conservatively. Avoid borrowing the maximum amount for which you are pre-approved. Instead, aim for a mortgage payment PITI or PITI HOA that does not exceed 20% of your net monthly income. B. Understand net DTI. Factor X. For financial stability, ensure that your total monthly debt, including PITI or PITI HOA, car payments, and credit card bills, does not exceed 40% of your net monthly income. Example. Hourly wage, $32.95 per hour. Gross monthly income, $5,711.33. Net income times 70% equals $3,997.93. Recommended mortgage payment of PITI, $799.59. 20% of net income. Total debt limit of PITI plus other expenses, $1,599.17. 40% of net income. Confused? Let me break it down for you with a simple example. You earn $32.95 an hour. Here's how you calculate your monthly gross income based on a 40-hour work week. Step 1. Multiply your hourly rate by the standard number of monthly work hours. $32.95 times 173.3333 equals $5,711.33. Monthly gross income. Still unclear? Let's break it down further. Step 2. Multiply your hourly rate by 40 hours. Per week. $32.95 times 40 equals $1,318. Weekly income. Step 3. Multiply by 52 weeks in a year. $1,318 times 52 equals $68,536. Annual gross income. Step 4. Divide the annual income by 12 months. $68,536. Divide by 12 equals $5,711.33 monthly gross income. Now let's account for taxes. Assuming a 30% tax deduction, $5,711.33 times 70% equals $3,997.93 monthly net income. Budgeting your net income. 1. Calculate your PITI, principal, interest, taxes, and insurance. Net DTI, debt to income. Front ratio equals 20% of net income. $3,997.93 times 20% equals $799.59 PITI. 2. Calculate your total monthly recurring expenses. Net DTI back ratio equals 40% of net income. $3,997.93 times 40% equals $1,599.17 PITI, plus all other recurring expenses. 3. Calculate your remaining budget. $3,997.93 minus $1,599.17 equals $2,398.76, remaining 60% of net income. C. Save for emergencies. Reserve at least 60% of your net income for savings, investments, and other essential needs. D. Manage credit wisely. Pay off credit cards and maintain only one for emergencies. And keep a small balance of approximately $25 to boost your credit score over time. E. Avoid overspending. Spend only what you can afford. Prioritize needs over wants. Occasional indulgences are fine, but consistent savings are crucial. Emulate nature's creatures like ants or squirrels who prepare for tougher times ahead. F. Buying a home. Focus on needs, not appearances. A home should meet your needs, not serve as a status symbol. Trying to keep up with the Joneses can lead to financial ruin. Make prudent decisions that align with your long-term goals and financial well-being. Remember, financial discipline is the key to stability and success. Congratulations! You've completed the lending institution section. Please proceed to the next video on the real estate company section. Feel free to revisit this section or any previous videos if you need further clarification on any information.